Revenue recognition concept. Again, this is also one of the very important concepts insofar as accounting is concerned, and I'll tell you why this concept is important. There are two events, as we had discussed in one of the previous lectures as well, which is supposed to take place in case of sale or provision of services. So let's say, for example, there is a sales transaction, okay, sales of goods worth rupees 100,000 on March 15, 2012, against which income has been realized, or not income, against which, let's say, cash has been realized in June 2012. Financial year ends March 31, 2012. Now in this case, if you note, what is happening is that there is a date of 31/3/2012 when the accounts are getting finalized. Okay, let's draw a timeline chart over here. So there's a date prior to the closing of books, which is March 15, 2012, and there is a date of June 2012. So you made some sales here, okay, the accounting year ended as on this date, and the cash was received on this date. The question is, when should the revenue be recognized? And this is the question which is actually sought to be addressed by the revenue recognition concept. According to the revenue recognition concept, the revenue should be recognized when the legal right to receive money is established. Now what does this mean? So when you sell the goods, is it that you get a legal right to get the money from this buyer? Okay, or is it the day when you receive the cash, you get the legal right to receive the payment? The difference that it makes to the overall situation is that we have this middle date, okay, wherein we need to prepare the accounts. Depending on when the legal right to receive the payment is established, this income has to be recognized either as a cutoff date of this, or if the legal right is recognized on this date, then ideally it should be recognized as income of 31/3/2013. Right? Now when you sell the goods, what happens? You basically give the goods to the buyer, right? The buyer is free to do whatever he has to do, and you have the right to receive the payment, okay, on the date when you make the sale. Why? I mean, today I might sell the goods to him, he might do whatever he wants to do with that. Even if he goes off and destroys the goods, who cares? I need my money, boss. I need the money to be paid back to me. Why? Because I have a legal right. So if the legal right is passed at the time of sales, which normally is the case, unless and until, let's say for example, this guy would have said, okay, I'll keep these goods in my godown for 1 month. If they are still in a saleable condition, then only I am going to pay you. Then the legal right does not arise. Please note, the legal right does not arise unless and until this 1 month pass. And this 1 month will actually pass from this date until April 15. So until April 15, I do not have a legal right to receive the payment, right? So what is important is, when does the legal right arises? If it arises at the time of sale, depending on the terms of the contract, then you have to book it as an income for 31/3/2012, failing which it has to move on to the next year, right? So this is what the revenue recognition concept tries to put into place.